Welcome to The Explainer. Today, we're going to completely flip the script on how you think about money and your financial future. The concepts we're diving into are absolute game changers, and they're built entirely on two fundamental principles: the wealth of ownership and the sheer unstoppable power of time. We're moving away from that old, exhausting earning to spend treadmill, and we're shifting the mindset entirely towards earning to own.
All right, let's jump right into Section 1, the income illusion, earning versus owning.
Okay, let's dive into this. We're often taught that building lasting wealth requires, a staggeringly high-paying job, pulling off some miraculous lucky investment, or starting a billion-dollar tech company. But what if the biggest difference between people who build wealth and those who constantly struggle isn't actually about how much they earn at all? Picture this. Imagine two people. They're both exactly 25 years old, and they both earn exactly $60,000 a year. The first person, they spend pretty much everything they make. They're constantly upgrading their phone every single year, they finance a flashy new car with hefty monthly payments, they eat out all the time, and they're basically buying things to impress people they don't even know. Now compare that to our second person. They consciously choose to live just a little bit below their means. Instead of blowing every dollar, they diligently invest 20% of their income every single month into broad market index funds. Their incomes are completely identical, but how they use that money, it's worlds apart.
Fast forward 10 years later, and their lives look completely, radically different. The first person, despite earning a solid salary for an entire decade, still desperately needs their next paycheck just to survive. They're totally trapped, just living paycheck to paycheck with that constant, grinding stress of making ends meet. The second person, though, they've quietly built an investment portfolio worth hundreds of thousands of dollars. They aren't stressed out, they have options. The profound impact of those tiny, seemingly insignificant daily choices over a decade is absolutely staggering when you stack them up.
Which brings us to Section 2, assets versus liabilities.
And this brilliantly illustrates exactly why that second person succeeded so massively, while the first one struggled. It's not magic, and it's for sure not luck. It just comes down to the basic mechanics of wealth. You see, wealth isn't built by income alone. It's built by ownership. Let's look at the absolute simplest definition possible. An asset is something that puts money into your pocket. Period. That's it. Whether it's a dividend-paying stock, a bond, or a rental property, the wealthy focus relentlessly on acquiring and owning these things. True ownership is the literal key to the whole shebang.
On the flip side, we have this fundamental definition. A liability is something that takes money out of your pocket. Sounds simple enough to avoid, right? But here is exactly where so many of us get trapped. The average person actually owns liabilities that are cleverly disguised as assets. Remember that expensive financed car we just talked about? Yeah, that is not an asset, it's a liability, draining your pocket every single month with interest payments, expensive insurance premiums, and constant depreciation.
This basic concept perfectly explains a fascinating real-world phenomenon. It's exactly why you can have people earning massive six-figure incomes who are completely, utterly broke. Come on, you probably know someone like this, right? They drive a gorgeous car, they live in a massive house, but they have absolutely zero savings. Their high income is entirely eaten up by their high liabilities. Meanwhile, you've got folks making an incredibly average salary who quietly become millionaires. How on earth does that happen? Because they're steadily using their average income to buy real, actual assets that generate more money over time.
All right, moving on to Section 3, the compound interest engine.
Now that we've got a handle on the incredible power of ownership, let's look at the engine that drives it to the next level. We're talking about the single most powerful force in personal finance. There's this famous quote attributed to Albert Einstein: "Compound interest is the eighth wonder of the world." Now look, whether Einstein actually sat down and said those exact words or not is totally up for historical debate. But it truly doesn't matter. Why? Because the underlying principle is undeniably true. It is an absolute financial wonder.
Let's walk through the exact math so you can see this engine actually doing its thing. Imagine investing just $500 every month into an S&P 500 index fund. This is a very realistic, attainable number for a lot of people. If the broad market returns its historical average of about 10% annually, let's see what happens after 30 years of just letting it sit there and compound. Because your money is continuously generating returns, and then, here's the crazy part, those returns start generating their own returns, the math just starts to exponentially run away with itself.
So the crucial point is, you end up with over $1 million. Let that sink in for just a second. $1 million. But here is the absolute magic of this equation. You didn't invest $1 million.
Over those 30 years, you only contributed a tiny fraction of that total amount. Your money did the heavy lifting. Your money worked for you while you were sleeping, while you were on vacation, and while you were just out there living your life.
Notice how the first 10 years in this growth phase feel incredibly slow, like painfully slow. It is so easy to get discouraged early on. You might even look at your account and wonder if this whole investing thing is even working at all. But then, as we move into years 10 to 20, the growth starts noticeably accelerating. The snowball is getting bigger, and by years 20 to 30, it is massive, exponential growth. The returns begin to completely dwarf your actual contributions. The longer you stay invested, the exponentially harder your money works for you.
That brings us perfectly to Section 4, Why Time Beats Timing.
So when people first see the math of compounding, they get incredibly excited. But then they often make a critical, classic beginner mistake. They try to time the market instead of just giving the market time. People wait around for the absolute perfect moment to invest. They tell themselves, oh, I'm waiting for a massive market crash so I can buy in cheap. Or they're waiting for interest rates to shift. Or they just wait until they get that next big promotion so they have more disposable income. Years pass while they wait for these perfect conditions, and they never start. Meanwhile, the people who just started and invested consistently, month after month, they are leaving them completely in the dust.
I really want to slow down here for a second, because this shifts everything. The market doesn't reward perfection, it rewards patience. The cost of waiting is astronomical when you factor in compounding. Just getting started, even if the economic conditions don't seem absolutely flawless right now, is vastly more important than waiting on the sidelines trying to predict a future that literally nobody can accurately predict.
Let's move into Section 5, the reality of true wealth.
Now, what's really interesting about this is that we all need to unlearn what we think wealth actually looks like in the real world. We've got to shift the narrative entirely away from chasing societal status and move it towards securing personal freedom. Society basically trains us to focus heavily on visible luxury, right? The flashy cars, the massive houses, the designer clothes, that constant, exhausting need for outside validation. Sure, a luxury car can certainly make someone look rich on the surface, but real wealth is actually quite invisible. It consists of unseen accounts, quiet assets, and ultimately, freedom.
Let's break down exactly what that invisible wealth consists of. It's the investment account that nobody else sees when you walk down the street. It's the intensely boring index fund stocks that nobody is bragging about at a dinner party. It's the modest rental property that's quietly generating reliable income month after month. It's the fully funded, completely unglamorous emergency fund sitting safely in a basic bank account. These quiet, boring assets, they are the actual, reliable engines of financial success.
And why are we building these quiet engines in the first place? Because the ultimate purpose of money isn't to buy status or to get validation from strangers on the internet. The purpose of money is to purchase your own personal freedom. True wealth buys the freedom to boldly walk away from a toxic job you absolutely hate. The freedom to take calculated risks on a new venture without the terrifying fear of ruin. The freedom to spend a random Tuesday afternoon with your family, entirely lacking financial stress. It's the freedom to live life completely on your own terms.
Let's move to Section 6 and see how this all builds together. 3 rules for wealth. If you are serious about applying this to your life, here are the 3 rules. They are remarkably simple, but I promise you they require profound discipline. Rule 1. Spend less than you earn. Rule 2. Invest consistently every single month, regardless of whether the market is up or down. Rule 3. Think in decades, not days. The people who become financially successful aren't always the smartest people in the room. They are simply the most consistent. Consistency beats raw intelligence every single time when it comes to investing.
Keep this specific insight firmly in mind as you start your journey. Most people wildly overestimate what they can achieve in just one single year, but they massively underestimate what they can achieve in 10 years. We are so wired for immediate gratification, but adopting that long-term mindset is exactly how you allow the incredible snowballing power of compound interest to work its absolute magic on your portfolio.
Which brings us to the final, and really the most important question to leave you with today. The question isn't whether investing works. The math clearly shows us that it absolutely does. The question is, are you willing to be patient enough to let it work? Because every single day you delay investing is a day your future wealth loses the chance to multiply. And in finance, time is the one thing you can never, ever get back. Think about that.